Hello, hardcore financial listeners. Welcome back. It's been a little bit since we've had a guest on, but we're very excited to have Rob Frasca here, who's a serial entrepreneur, has sold a bunch of companies, one into Nielsen, which I have some background in, but mostly Rob is a lot in fintech now. Rob, we'll let you do your own background, but we're very excited to talk to you because we're going to do a 2021 recap of crypto and look ahead to 2022. I know right now you're very focused on crypto. You run a VC fund, but give us a little bit of a background about you, and then we'll just jump right in.
Yeah, sounds good. Well, thanks for having me. I've been doing tech now for almost 30 years. I started the very first financial service, believe it or not, on the internet way back in 1993. I was at Carnegie Mellon getting my MBA. Internet was happening, and I saw the internet, and it was just, I got to do something here. So we actually put the very first commercial stock quote server on the internet. I negotiated with Morningstar and S&P, put Charles Schwab and over 100 financial institutions. And I sold that company when I was 29. It was acquired by Bill Campbell and Scott Cook of Intuit. And I moved out to Silicon Valley. I did a lot of their internet strategy there at Intuit, and then went back to Pittsburgh. I was sitting on the board of an AI company called Wisewire, and went back there to get back into the startup thing. And we started one of the very first AI companies. And that company was acquired by Lycos. If you remember Lycos, most people don't. It was the #2 search engine at the time. This was right around 1996.
I remember it well. And that ages me. I was using the internet back then.
I know. I'm in my 50s. So, my son is like 26 and he's like, glucose? What the hell is Lycos, But we took it public, and then we sold it to Telefonica for almost $6 billion, which was a wild ride. And then I did another company which was acquired by Nielsen. So, and another one. I did another one that was voice over IP. So I've been doing tech companies now for almost 30 years. And I got the religion on blockchain, I want to say 5-6 years ago. We have a venture fund called COSIMO Ventures. There's 4 partners, 3 other guys, all serial entrepreneurs. Ken Lang, our CTO, is one of the guys I did a company, that AI company with. He's one of these polymaths out of Carnegie Mellon, 5 to 10 degrees, and he kind of, started showing us Bitcoin, I would say I lose track of time, 7 years ago, 8 years ago. And we were buying Bitcoin at that point. And when I saw blockchain, I was converted. So we created a venture fund called COSIMO X. It's a tokenized fund. It's a security token. Securitize, we were their first paying customer. I think we're the only evergreen fund. So it's open-ended. There are a bunch of other closed-end funds, Spice and Blockchain Capital, a few others, but I think we're the only open-ended one. So we're very much into blockchain. And one of the things that I say all the time is all my partners and I, we always kind of sit back and say, man, I've seen this movie before. I've seen it. I've been in it. I know how it's going to end. And this is happening all over again. And I say all the time, I personally believe that blockchain, with no hyperbole here, I believe that blockchain is the single largest value creation event in our lifetime. And bigger than the internet, bigger than mobile, it's going to be huge, absolutely huge. So that's a little bit of my background, a little long-winded, but I love everything blockchain, and I'm all in.
That's fantastic. And you raised a really good point. I also believe, Alex and I think also really believe that this invention is very, very foundational to humanity, because basically we've never been able to kind of agree on stuff in a decentralized way. And if you think about like the implications of that, so many of our societal structures exist just because we haven't been able to agree on stuff just in general. So when you say the value that's going to be created, do you have any thoughts on like how much of that value is just like the monetary value of, like, for example, something like Bitcoin, which is like the the monetary layer, then you have like all the smart contract layers on top and all of the others, identity. Like, do you have any thoughts on like how this value will be distributed among different projects, or is it too soon to say?
Well, when you think about it, I was, if you take a step back, all this is really a progression, and the early days of the internet was really, the internet. Look, the internet was designed to be a resilient network to survive nuclear attack. Mm-hmm. That's why it was designed. And the first phase of the internet was really just about kind of decentralizing content. And that's the first company I did. It was called Net Worth, and it was about decentralized distribution of financial content. And so, we went from a world where there was ABC and NBC and CBS and PBS. And I used to get my news, watch TV on 4 stations. We went from that world to this, massive distributed world or decentralized world of content where anybody can be a content producer. And then the next phase of it was really around communication, voice over IP. I did a company in voice over IP. It was sold to Unity. When you go on Sony PlayStation and you're playing Fortnite and you're smack talking the 12-year-old that you just killed. That's using Vivox, which is part of Unity, which is a company we did. And then, the next phase of the internet was really about commerce, e-commerce, right? All of a sudden anybody can sell anything. My wife sells antiques on Etsy. And eBay, right? Starting selling Pez dispense collection, right? So we've kind of got this progression of decentralization, but you said it. Our entire society is based on centralized trust. And now all of a sudden we've got this technology that allows us to basically decentralize the whole concept of trust and move it to, I love this book by Neil Ferguson. He is called The Tower and the Square, or The Square and the Tower. I always get it mixed up.
I love that book, yeah.
Right? Yeah, it's basically about how we've gone from these kind of hierarchies, these central points, to this town square, which is networks. And so that's what blockchain really is. So you asked me, why is it so big, or do I believe it's going to be cryptocurrency, or all of those kinds of things? I think that anywhere, look, our society is created by what? Institutions of trusts. If I don't know you and you don't know me, what do? We put a bank in between, right? Or we put a broker, or we put a Department of Motor Vehicles to prove that I'm Rob Frasca, or some kind of central institution or a government or whatever. And now all of a sudden we've got to reconstitute that in a network and get rid of the middleman and create more resilient kind of distributed trust. So that's why anywhere there's trust in the fabric of our society is going to be essentially recreated or redone or re-implemented, if you will, on a network. And so, so it's not just currency, it's identity. It's the whole NFT thing is really digital rights management. I can't stand they call it NFTs, right? So it's all about decentralized digital rights management. That's huge in itself. That's God, how many trillions of dollars is that? So when we look at it, I think we kind of broke it down into six different areas, and you could break it down into 20 different areas. It's whatever's manageable for you. But I think it's just for us, it's really looking at how does this technology change various institutions of trust, and then what are the projects, or what are the companies, or who are the people, who are the entrepreneurs that are solving the problems around those specific areas. Last time I checked, for instance, identity, you mentioned identity. Last time we checked, I think there's like 42 companies or projects doing stuff in identity. Who's going to be the winner? Is there going to be one winner? How does it play out? It's hard to say. It's a long-winded answer, but I really think that this is really, that's why it's so big, because it's kind of the value layer. It's the trust layer of everything we've just built for the last 30 years. And that to me is just pure alpha from an investor perspective.
Let me follow up on that. Shimon and I and you share a lot of the same perspectives. We completely believe in it. We're almost triple leveraged in it, regular leverage and career leverage. We kind of jumped right in. It still seems to me, though, that a lot of the traditional finance, the world, there are two themes that I think they don't understand, and I'd love to explore with you. One theme is regression to the mean, And I think the traditional financial world does not understand exponential scaling, even though we're always exponentially scaling. So everyone thinks we're going to regress to the mean. And I think the other one is, they still see crypto or Web3 or removing of the centralized party layer as a partly get rich quick scheme, right? And all these things are just popping up in value. And it's almost like in a bull run, you can't go wrong about where you put your money. So can we talk about those two things? Again, when you judge investments, do you think about regressing to the mean? Is that even a realistic metric to manage towards? And secondly, if you don't, how is it that all these projects are getting money? I mean, definitely some are shitcoins, and I've seen a lot of my profession in my day-to-day of shitcoins. But why is there so much alpha to go around? You talk about being early. Why is it the case?
Yeah, so there's a bunch of questions there. Let me start with the first one. So, we're a fund, right? So we're always out raising money, and I'm always talking to institutions. And in the early days, I would go to family office events, or I'd go to institutions. A true story. I go to a bank to talk about blockchain, and they literally kicked me out of the room when I started talking about Bitcoin. Okay, so the thing that I hear a lot from a lot of institutions, because they just don't get it, right, is they go, I like this blockchain stuff, but this crypto is crazy. I don't agree with the crypto. And I always take a step back and I say, well, wait a minute, guys. What we're talking about here is the business model of blockchain, right? When you think about the tower or the centralized banking model, the banking world or the centralized trust world, right? I'm making that kind of tower symbol. How does the tower get paid? How do these guys get paid? The business model is real easy. There's one guy getting paid a transaction fee. That's it. When you take that model and all of a sudden you put it onto a network, and you got to incentivize that network to do things or not do things, you have to create an entire different business model or payment infrastructure. And that's what crypto is. So you can't have one without the other. If I'm going to create, these consensus networks, then I have to create some kind of payment rail to pay everybody on those networks. So I believe that the institutional market is now starting to figure that out. I think that they're starting to realize that, holy cow, the business model of these trust infrastructures is really around the value of the network. And the value of the network is how many people are on it, what's the velocity, what's the value stored. Like, you have to go from this kind of P to E, price earnings ratio valuation model to network models. Now you mentioned the other thing, exponential, regression to the mean, averages, all of these kinds of things. Human beings just don't think exponentially. They can't. It's just not in our brain to do it, okay? Yet, how do networks grow? Exponentially. Now, figuring out what the exponent is, that's the magic, okay? But we know it's still growing exponentially. So if I've got this payment rail that is kind of a proxy for the value, payment rail meaning token, meaning crypto, if I've got that as a proxy for the value of my network, and my network is growing or not, or there's a lot of value in it, and it's growing exponentially, then I have to kind of think about where this is. The problem is that because it's look, I saw, you mentioned the other thing, get rich quick scheme, all that kind of stuff. You know what? The early days of the internet was the same thing. Okay, there was a .com bubble. I was part of it. There was pets.com, anything.com, and the thing went crazy. All right, and then the bubble popped, and then where are we at now? We're at 5-10x now. What that was. Most life after, most of my world was prior to Google even being formed. And most people don't realize Google was number 12. I know I'm talking about a lot of stuff here, but if this is kind of early internet days and it's growing exponentially, then it's not get rich quick. We have to think about different ways of valuing what we're doing. So that's what we try to do as investors. What we try to do in investors is, number one, figure out where are we in the cycle early. Two, understand the value of what's being created from a network perspective, not from a company perspective, not from a priced earnings perspective, but an overall network growth. And then make bets on a full kind of ecosystem of how this technology plays out.
Yeah, I mean, you raised some points that are really important for our listeners to understand. And we even had an episode, Alex and I, where we discussed why looking at PE ratios is not really informative. I'll never forget, I think I've said this story on the podcast before, many episodes before, but when Alex and I were at Kellogg, Facebook was just about to IPO. And our accounting professor, which was one of the best accounting professors in the country, did a lunch and learn of like, can you justify a $33 billion valuation for Facebook? And he started looking at all these financial, because that was the initial IPO. He started going through all these financials and he's like, this doesn't really make sense because like something like this has never existed. And he showed comparable companies, right? And it just doesn't make sense. What he didn't understand is that a network like Facebook has literally never existed before. So of course, when something like that IPOs, the dry financial metrics you will see will be stuff that never existed before. Same things with people that talk about the stock market right now. And they're like, oh, it's so overvalued because we've never seen price to equity, PE ratios like that. And Alex and I were talking about this. A PE ratio is basically just an expectation of like growth in the future. And like, does anybody have a problem with saying, the companies that currently comprise the stock market are growing much faster than companies 100 years ago? Like, I don't think that's controversial. So then why do people have, it's this bias of like trying to explain the present with the past. And I think that's like, that's why many people lose out on alpha. So that leads me to the question to you. What do you think is kind of the least well understood aspect of crypto by traditional investors or by like kind of the average investor out there, whether it's institutional or retail? Like where do you think people get something wrong?
I think it's what we just talked about. I don't think the average crypto investor understands what the value of the network is that's being built. So, what is the value of the network and the people on the network and the nodes in those networks and the amount of trust that's being performed, or the number of trades that are being cleared, or the transactions the contracts, how fast is that network growing? I think a lot of crypto traders, they look at the tech, or they are speculative. They're looking for, a lot of quick alpha. And I don't think that they really are internalizing what does it mean for this network to truly be at scale? How valuable will it be? And how much value can that network create? And I think that's the biggest, misunderstanding out there. I'm starting to hear more and more. I did a podcast the other day with a gentleman, I can't remember, and he got it. It was a young guy. He was in his 20s, and man, like he got it. And it was like, I was actually surprised, because you would think most time you're surprised when somebody doesn't. I was just surprised at the level of, holy cow, these are networks. And so I think that's probably the biggest misunderstanding. Look, when we talk about alpha, there's two kinds of alpha. There's alpha and alpha at scale. So if you think about an exponential curve, the biggest alpha is actually in the beginning, but there's no scale there, right? You might have $1 million of alpha, but you don't have $1 trillion of alpha. So what happens is as these networks grow, the actual growth rate is the highest in the beginning, but the key to try as an investor is to try to get it where it's at scale. And there's liquidity, and you're managing kind of the liquidity scale aspect of that alpha. And I think as investors, you kind of have to put yourself in different buckets. From a venture perspective, what we do is we invest in two asset classes. One is we take preferred equity. old-fashioned venture equity, preferred equity, standard kind of term sheet. The other thing we do, because not everything's going to be a network, okay? But then the other thing we're doing is we're looking for what I would call illiquid early stage tokens. So our idea is if you're getting in early at a relationship level, why not get it when you're getting at a much, much, much cheaper price, generally much cheaper than listing price, and maybe it's locked, maybe it's got special provisions, what have you, but it's illiquid. And then what we'll do is we'll kind of blend that as a portfolio. That's kind of the traditional venture model, right? The traditional venture model is illiquid assets. You do a seed, you do an A, you do a B, you do a C, you do a D, and hopefully the thing goes unicorn or it gets sold and it doesn't blow up and you get liquidity at the end of it. What we're seeing, so that's kind of our analogy. Whereas you have hedge funds in the market who tend to buy more liquid assets. That are more tradable, and they do more trading because there's more liquidity, and so they might have an option there. So that's what we're about. I'll tell you, this is a really interesting topic, and it didn't occur to me, quite frankly, until we started getting into this. And I'm in some venture funds. I get checks in the mail. I'm like, what the heck? Where did this come from? I invested in that fund 10 years ago, right? And because the typical venture fund is you're locked up for 10 years, you're investing for 5, you're harvesting for 5, and then there's some extensions on the back end of it, right? And so because of that kind of blind pool lockup, what you have is there's not too many people that want to be in venture capital unless you've got some big money and you're an institution. So what we tried to do is tokenize our fund so that you're not locked up, and so that you can get in this. But to my point, the thing that happened to me was all of a sudden I realized, and this is key, and I observed it. It wasn't something I kind of went, and that is this stuff gets liquid fast. So the traditional venture timeline, right? The average deal to exit across 17,000 funds in the fund database of venture capital is like 4.6 years. I think the average time to unicorn status is like 9 years, maybe 8, 10 years, somewhere in that time. I don't know the exact number. And the average time to actual getting liquidity on unicorn is out past 12. This stuff that, these projects, these things we're doing, man, they're getting liquid in a year, 2 years, and they're getting liquid at crazy valuations. Maybe not with like ultra super liquidity. Like, I'm going to be able to I got to go sell $20 million of it at a drop, but I'm still getting some kind of liquidity in the market. So that's an interesting thing. I'm holding long, I'm holding shorter. I'm getting liquidity faster. And then I've got to think about what happens once it becomes liquid. Do I hold on? Do I sell? Do I recoup? So all of a sudden, as a venture capitalist, I'm thinking about things that I wouldn't say normal kind of traditional early stage venture capitalists are thinking about.
I think so. Well, this is what I love about the space, actually. It's that it moves fast, not only because it's in its prime innovation period, but because there's so much liquidity. I mean, again, theoretical liquidity. A lot of it is paper liquidity, but there is enough liquidity to go around that projects just have to constantly compete on innovation, or else the investor is going to go next. And that forces an even faster and an even more virtuous innovation cycle. Just, again, this is something that Shimon and I talk about a lot on the pod, but when we think about fintech, for over the last 20 years, if we're honest with ourselves, there is not a lot of innovation there. There's UX innovation. There is some maybe business model improvement around the edges. There's nothing like an Olympus DAO that says, hey, we're going to create a stable and you're going to have a share, right? A locked share that's going to rebase automatically 3 times per day. Or there's something like even DeFi 1.0 that said, hey, we'll forget market makers. We'll create liquidity pools and it'll automatically make the market, and by the way, never go down. And by the way, do 5 billion per 24 hours in volume. I mean, that is a fundamental step change in innovation that's never been there before. And that's just it's super exciting. It creates pure competition. Ultimately, when you have pure liquidity, in maybe academic terms, right? When you're pure liquidity or pure competition, people can move in and out as needed. And so projects are forced to keep on innovating. And so, I mean, I hope you see the space in the same way as you're looking at projects and tokens.
Absolutely see it in the same way. There's one big important thing I want to emphasize in that, and that is that the value base, okay, is growing exponentially behind that. So not only is it ultra competitive, not only are there new solutions being created, but the overall scale of those solutions, because they're joining an already massively growing market, okay, just throws fuel on the fire. And so you know, I like to think of it as, if you think about it in terms of just audience base, you know, in the early days of the internet didn't grow much because the internet was small and it had a pretty small base. Now the internet is huge, and when you put something out there, there's such a large base of people underneath it that are available that it grows much faster. So you need to make sure that you keep that in perspective as we think about this. If this is really the first inning, right? If you look at kind of standard product diffusion theory, right? You know, I'm a geek from Carnegie Mellon, right? So, you know, the 5%, the visionaries come on and they come up with something. Wow, that's cool. There's a lot of alpha there, but a lot of problems. And then the early adopters come in and they're about 10% of the market, 8 to 10%. And they fix a bunch of those problems and then they jump in. And then there's this magic moment, right, at 12 to 15%. I say this over and over and over again. You jump the chasm into the tornado and you're off to the kind of early majority. I would say that's where we're at. We're at that point right now. By the way, if you play that back to the internet, Google didn't enter the market until they were around 20 to 30% market penetration. So they were post visionary, post early adopter, and just kind of, okay, early majority coming in. So to predict that the existing technology that's out there today is going to be the winner, they could. I'm a big fan of Bitcoin, so I'm not poo-pooing Bitcoin. Please don't take it that way. But odds are that, you know, the majority of the value is going to be created by something we haven't seen yet.
Yeah, that's a fascinating
definition.
That's exactly a fascinating point. I actually think that, so I had the privilege of like going through the dot-com boom. I was still in high school, but I was lucky to get an internship at a tech company, and they sent me to New York for like a conference. I remember March 2000. It was exactly when it started to pop, and I was in New York. And I just see so many parallels to this market in many dimensions. But like one thing you mentioned, I think we're actually more early than the early adopters if you just look at value. Like, yeah, if you count the people, then yes, we're probably at the early adopter stage. But if you count the value, if you draw like the curve of the value in crypto, we're way early, because I think most people still have their value in traditional assets, right? Bonds, real estate, stocks, stuff like that. And so it's going to take time for people to understand where this alpha is coming from. And yeah, it's very interesting. I wanted to ask you, where do you think, for example, when you talk to people, what is the one thing that most people get wrong about next year? Versus what you believe in? That's like a fun question, which is like, you know, there's many things that people agree on that will happen next year. There's many things that people, you know, think they won't happen, and everybody agrees that they won't happen. But is there anything that you think like, yeah, it will happen in 2022, but like most people disagree with me on that?
Well, my caveat is, and I said this before, we all suck, okay, as exponential thinkers.
Yeah.
Doesn't matter, okay, who you talk to. You look at estimates, and every time you try to estimate or predict how something like a network grows or what it does, you're just going to get it wrong, because we just don't think that way. And so I got some major I've made some major wrong bets. I've made some good bets, but I've made some major wrong bets too, in terms of, and it generally comes along with timing. So I think generally people get things wrong because they're not thinking exponential. Look at DeFi, total value locked in DeFi. If that's not exponential, I don't know what is. Doubles every 2 months. I think it's beyond that now. That rate is doubling every 3 months. So that to me is wrong. One of the things that I worry about are externalities that I can't predict. Coming back to macro, I just read Ray Dalio's Changing World Order. Did you guys read this thing? U.S. is on the downturn, right? He built a model, an AI model with 18 determinants, talking about, long-term debt cycles, short-term debt cycles. He said most people don't understand long-term debt cycles because they're outside of the average lifespan of a human. The one thing he doesn't talk about in that book is kind of what crypto could, how that could help, which I think it could. So anyway, I guess with us printing money, with the pandemic, with, debt at a level where, Jesus, how the hell do we ever repay it? The stock market where it is, what happens, those kind of macro events, I think they're going to create there's a potential for a lot of short-term pain and a lot of value dislocation. So I don't know how all that plays into the broader blockchain crypto world. I don't. I think it's a hedge. I'm betting on it. But I don't know how that's going to play into overall predictions.
Let's stay on macro here, and so I have a two-parter. Do you see a correlation or a deeper correlation between crypto and stocks? And then secondarily, we know there's going to be 2, potentially 3 rate hikes next year. When you're talking to institutionals and investors, how are they thinking about crypto as a risk-off asset? I mean, again, it goes along with correlation. If you believe, the market and crypto are both risk-on, you're going to pull back. If you believe that they're decoupled, you can hedge with crypto. And then maybe, I don't know if you see a difference between crypto and Bitcoin specifically. Like, does Bitcoin still have a special? Do people understand the difference between, the Ethereum and smart contract world versus Bitcoin? I mean, they're going after 2 different TAMs almost. So what's that macro perspective like?
I don't think that most institutional players are even thinking that way. I think the smarter ones are, the more pioneering, visionary thinking are thinking that way. Grayscale published some great stuff. I always love their investor deck, right? They talk about, with a 5%, they do a 60-40, traditional portfolio. And then what they do is they show what happens to your return, your risk, your Sharpe ratio, et cetera. They do a really nice job. And, 1%, 2%, 5%. And I think with a 5% allocation on a 60-40 standard global portfolio, you're going to get a 52% bump in ROI attributed to only 5%. And that, and the Sharpe ratio, I think, goes up, another double. And so, I look at it and and it's like, not the question of why should I do this, is the question of how the hell could you not? Right? You take 5% of your assets and you put it into crypto and you're getting a 52% bump across the board. That's if there's ever a no-brainer free lunch, that's it. I don't believe that the average institutions out there they get it. I don't think they see it. I don't think they realize it. I mean, Ray Dalio just came out, 2 weeks ago, right before Christmas. I hate to date what time because on these podcasts, but, right before Christmas, he came out and said, geez, I think you should have crypto in your portfolio. Again, so to answer your question, the institutions I'm talking to, I don't see them there yet. And I think the majority of the reasons why they're not there yet is because they're still waiting for, more regulatory clarity and compliance clarity, which, by the way, that's a whole nother topic. But for me as an investor, I actually think that every time there is any kind of regulatory clarity, it's a beautiful thing, because that takes more risk out of the system, more capital comes flowing in, and, more value to everything that's getting built. So I'm a big fan for regulatory clarity and compliance. I'm not a big fan on stupid regulations when they are, not well thought out, but I do think clarity is important. So if there is a kind of world debt crisis type of event, I believe that crypto's going to get even more attention than it probably already has. I just don't know how. I haven't really thought through how that would play out.
Yeah, it's great.
Have you thought through it? I'd love to hear what you guys think.
So I just wanted to say, first of all, hot take here. I disagree with Alex. I think that after the first rate hike, they'll get spooked and not do any further rate hikes. I really don't think that with the levels of debt that we have, that they can increase the interest rates in any meaningful way. Especially since the one thing that COVID made very clear to me that wasn't very clear to me. I'm kind of like a macro geek. I really love to nerd out on this stuff. And like the level of coordination between countries on the money printing was really astonishing, right? So like usually you learn in business school, like traditional international finance. We had a really good professor, Alex and I. And they're like, yeah, you print money, then your currency weakens, then it's good for, whatever, import, export. But like, what if everybody prints money at the same time? Like nobody has thought of that, or at least nobody has taught me that. And it's a very interesting situation where you can just like slowly inflate the debt away. And then there's another option. I mean, if I had to give like my optimistic view, right? Like that's my hot take, which I actually think that next year will be very good. And we will not have any crisis, like any meaningful crisis. Like I don't consider basically March of 2020 as a crisis, because like that's the other thing. Like they just dumped so much money so fast onto the markets and like bought like corporate debt. It's the stuff that was just like very, very blatant, and they used COVID as an excuse. And so I really think they can keep going with this. And Alex and I also subscribe to Kathy Wood's thesis of like, the deflationary nature of technology. And so that could offset a lot of the money printing. So that's kind of the optimistic scenario, which is like you keep inflating the money at 10%. And as long as you have, or 15%, and as long as you have like a 12 to 13% like productivity growth together with it, then CPI nets out.
That's the big caveat.
Exactly.
Right
it all hinges on that, right? It all hinges
on that.
But on the other hand, like just when we think about it, like automation is just like huge, just good old fashioned automation, nothing crazy, like not Boston Dynamics. I'm talking about like McDonald's putting like, screens where you can order, that stuff has a lot of room to grow, I think. But so that's like my take. I think that governments will keep printing money. It will keep propping up the assets. But my question is, I don't know, actually, I would love to hear your thoughts on what Alex asked, which is like the correlation between the stock market. Like, I'm not so sure about this idea that Bitcoin is a hedge. I think if the system collapses, I think Bitcoin will suffer. But I don't know. I don't have any data.
Rob, before you answer, I want to just to give a little bit of my take since you asked. And look, this is why I disagree with Shimon. I think they're not going to increase rates by a lot, but you can bump them up 25 basis points at a time, go to a half to 0.75, even to 1%. It's nothing. We're still the market's freaking out from a more hawkish Fed. That's bullshit. There's still quantitative easing. We can even go up to a point, 100 basis points a percent Fed funds rate. Who cares? In the grand scheme of things, it's still very low. They're not going to hit 3%. So what I think is going to happen, and this will happen especially if there's a global debt crisis. So you're right. There's been a coordination, right? And so when there's a typical coordination of money printing, there's a flight to safety. Typical risk off is the US dollar. And so I think that if there's a major crisis and they really increase rates, Bitcoin and everything will suffer. I think ultimately it will recover faster, just like it did, in March 2020, because people now realize what it is and what it isn't. But I think what's going to happen if there is a major financial crisis in the world, well, here's what's going to happen. Bitcoin will become much more prominent, as will the US dollar via stablecoins. Stablecoins will be the primary export of the US dollar. We're going to go back to 80 whatever % of the global reserve, being used in US dollars. And crypto will be the only channel to actually do that. I mean, Shimon and I talked about it a lot. Shimon had a good point of, stables is a great way to export US values without shedding any blood, because everyone in the world wants to go into USDC. We're not going to talk about Tether. We'll leave dirty players unnamed. But I actually think this will be an acceleration, just like COVID was a tech acceleration. Another financial crisis of the magnitude of 2008, 2009 will expose the current system, how it brings down everyone, versus crypto, how it stays resilient. People will ultimately come back into crypto. I mean, it will be very painful in the short term, but in the long term, it will be crypto, US dollar, maybe a couple other stables, and all the other countries will fall into either the Bitcoin standard or as a store of value, and the US dollar as a means of exchange, because nobody's buying anything with Bitcoin. I'm not a fan of all these, new Bitcoin ATMs or accept it here. That's bullshit. No one's using Bitcoin to buy stuff. No. But Bitcoin will be settled, will be the settlement layer. And that's all it needs to be, ultimately to be a huge win. And if there's more, then it's just a, astronomical win. So anyway, that was my take. I do think there'll be rate hikes. I don't think they'll freak out, but I think it'll be tiny. You increase by 25 basis points. Ultimately,
what do you think? What do you think of China's CBDC? How does that play? I
think it's I have to be careful about what I say.
Right. By the way, in the U.S., when you talk to people in the U.S., they don't care. They don't talk about it. It's not a topic of conversation anywhere. You go outside of the U.S., especially in Asia, that's all they.
What do they say? I mean, what can China do with any CBDC that's programmable by any CBDC? Takes away the whole point.
China wanted to create a new global. I'm just throwing this out. I don't have an opinion. I'm going to caveat. I don't. I'm just kind of thinking through it. If you're China and you wanted to create a global reserve currency very quick, I mean, really make your currency a true global reserve currency, how would CBDC play into it, and how would you game board that out?
Here's my thesis.
What would be your move?
Yeah, here's my thesis. China can do it, right? But any CBDC inherently involves trusting the government. Oh, who makes that CBDC? So whatever your perspective, if you are a big fan of the Chinese government, then you're gonna trust it. If you're not, why would you go into that versus a stable coin, let's say, that's essentially the same thing as a CBDC? And I think ultimately what we've seen, crisis after crisis after crisis, whenever there's a global financial crisis, there's a flight to the dollar, right? There's a flight to safety. And so I just don't see any non-US dollar, maybe the euro, maybe the Chinese, yuan or the CBDC in their sphere of influence.
How do you think, I mean, I'm just trying to think through how does that change? Right? How does that ultimately, and that's one of the things that, for instance, Ray Dalio talks a lot about in this book, right? His latest book is just how, reserve currency's status changes. It changes over time, and it generally changes in a major debt crisis. And so ultimately, if that's true, and I'm not saying I'm not by the way, by any means, I'm not saying I believe this. I'm just saying if that's a possibility and that's true, then it might make sense to think through how that would happen.
So for me, I think that basically the whole idea of CBDC is a little bit of a moot point. The important thing is the reserve currency, because like a CBDC is basically like forcing everybody onto a Venmo, and then you can control their spending behavior. You can
Right.
give discounts on good things and tax bad things higher and behavior and all of that stuff. But like, that's less exciting to me, or I don't, some people are really freaking out about it. It's like, oh, it's going to be a totalitarian state. I'm less freaking out about that. But the reserve currency, my thoughts are basically throughout history, the reserve currency has always been held by the entity that can project the most power. And that's just like unassailable. It was like, the Portuguese, the Spanish, the British, then the Americans, right? So, and the yuan is effectively pegged to the dollar, right? So that's what people, I don't understand when people say China will do this, China will do that. Like, let's first talk about them breaking the peg and having their own independent monetary policy. And then we can discuss like CBDCs. And like, I don't see the dollar going anywhere because all of the major inventions of the 20th century have been, and I'm actually very bullish on the US. I disagree with Ray Dalio. I think Ray Dalio has this brilliant way of analyzing the past, but again, they fall into this trap of like thinking, oh, this cycle has to repeat. Like, why does it have to repeat? Like, why can't it be like the last cycle was 80 years and this cycle will be 300 years? Like, why what's so magical about the number 80? Like, I don't get it. And I think the idea is like, just think about it. The major technology was created here, like flight, computers, telephone, internet, cell phones, smartphones, everything, even DNA, all of that stuff, right? So I don't see any other currency being able to like become the global. Now, what you can do is, you can have some kind of peg to the dollar. I mean, in Israel, what do? They're like, okay, we're a small country. We're going to have our rate fluctuate between 3 shekels to the dollar and 4 shekels, right? So it's like, if it's above 4, we're going to buy. If it's below 3, we're going to sell. That's effectively a peg, right? So I think that everybody will converge on the dollar in one way or another. Just because I don't see any other country inventing major technologies and taking over.
Let me just add one more thing, Rob, and I'd love to get your take. Just one quick thing. We talked about this. I forgot which episode we talked about. But ultimately, if we boil it down to first principles, it's power, and it's kind of the ultimate power of good. A country cannot have a reserve currency with capital controls. You just can't. Because someone will go to a different country with no capital controls. If you're saying, hey, I can't exchange my blank money for the Russian ruble, or I can only unlimited, I'll go to a different currency that I can exchange it. There's fluidity, which, by the way, crypto ultimately has. And this is why I think the U.S. will never ban crypto. We had this conversation. Actually, we should recap, Shimon. We had this conversation almost a year and a half ago or a year ago. We gotta bring some of these things back. But U.S. can't ban crypto if they want to stay in the reserve currency of the world. And China, who has capital controls, will never be able to see the light of day of having a reserve currency, because especially in the world of crypto, where you can go from stable to stable, and there's liquidity. Rob, to your point early on, you're not going to go to a currency of a country with capital controls versus a country with less capital controls. Fundamentally, one thing is objectively better than the other,
Yeah, I agree. Well, it's a good conversation.
So
now,
maybe
back to Al.
let's get back to.
How do we
so
out there?
We have 5 minutes. Let's talk about 2022 and your fund. What do you see? How do you see 2022 unraveling? Give us the optimistic scenario. Give us some hopium. We want some hopium as the last episode of the year.
Yeah, look, we're busy raising money into our fund and growing, doing deals. We're up to around 18 deals. We've done some great ones. And I think 2022 is really more flow of value into the system, more institutional players into the system. We just brought on Rochester Institute of Technology into a tokenized, blockchain fund. That's huge. And so and the kinds of conversations that we're having are with major, massive institutional players. So I think 2022 is really about more early majority institutional players, lots of capital coming in. And I think overall, the market is going to start realizing what we're doing here in terms of building networks. I'm very excited about what's going on with decentralized digital rights management I don't like calling them NFTs because I don't care about the NFTs themselves. What I care about are the platforms that allow distributed content, developers and creators to get paid. So I think that's really what 2022 is number one, lots of institutional money coming in. Number two, a lot of these networks coming in to create some serious scale. Number three, digital rights management, decentralized digital rights management is what I'm calling about. I think it's going to be big. And then on the DeFi side, I wouldn't be surprised if you start seeing some major institutions jumping in on the DeFi side to really create a catalyst for growth, more alpha. Ultimately, we're tokenized, so what we're trying to do is really democratize venture capital. And one of the things that there are two things I'm really super excited about. Number one is that this is global. So it's not a Silicon Valley, Boston, New York, US-centric approach. It's totally global. That's exciting to me. And then number two, you guys said it in the beginning. This is, 50% of the world, I think, is unbanked, and it's somewhere between 75 and 85% have a mobile phone, a smartphone. This is the technology that essentially allows a huge group of people to kind of come in and create more productivity and join that financial ecosystem. And there's DAO in that. There's true DAO in that. And I think that, to me, is the reason why I get excited about it. And I think that's going to even more, take off, more global, emerging markets embracing this.
That's awesome. Well, before we close, we like to ask our guests for what we call a hot tip for our listeners. It could be a good book to read, a good show to watch, a cool place to visit, a good dish to eat, literally any tip that doesn't necessarily have to do with finance or crypto.
Well, if you're in New Haven, Connecticut, the best pizza on the planet is Pepe's. How's that for a tip?
Great. It's awesome. So
this show is sponsored by Pepe's.
Pepe's is on my mind. And I would definitely read, that book by Ray, that latest one. I think that one was definitely an opener. And the other one is the older one, Niall Ferguson, The Tower in the Square. I think he plays it really well. He talks about history and how history is really built by networks.
Yeah, I just finished Niall Ferguson's Empire, about the British Empire. Oh my God, this guy is so deep. And he gets crypto. He actually wrote an op-ed. Amazing. So yeah, I'm a big fan of.
I haven't read that one yet.
Yeah, it's very good. But in any case, thank you so much, Rob, for coming on the podcast.
Thanks for having me on.
Can you please tell our listeners where can they find you online? How can they learn more about your fund? Anything else you would like to share?
Sure. I'm on Twitter at Rob Frasca. And our fund is COSIMOX.com, COSIMOX.com. And by the way, we called it Cosimo after Cosimo Medici, who was the patron father of the Renaissance and the banking system that we know it back in the 1400s. So we figured, as a tribute to the old banking system, as we move into the new one, we'd call our fund Cosimo.
That's fantastic. Yeah, I've been to Florence. I hope that one day San Francisco becomes like Florence.
There you go.
One day, and this day may never come, but one day we hope.
We'll see. But yeah, thank you so much, Rob. We'll put all of these descriptions. We'll put all of these details in the show description, and I'll definitely look more into the fund because, like what you said, makes a lot of sense. Which is like I'm mainly in Bitcoin now, but I definitely want to somehow get the upside of like everything that's out there, and I haven't.
Exactly.
I knew Bitwise a little bit, but they're just like kind of indexing, so that's less interesting to me. So yeah, I encourage everybody to go check COSIMO out. And with that, thank you very much.